With interest rates going up at a pretty good clip, many people who are in the home search are making the decision to head to the sidelines till things cool down. But how long could that take? If you're a regular listener of the SLO County Real Estate podcast with Hal Sweasey, you know the earlier you get into the market, the quicker you build equity. With so many people bowing out of the game, right now might be the best time to take advantage of less competition. Ermina Karim from Guaranteed Rate and Chad Van Til from Pacific Trust Mortgage joined the crew to go over financing options that buyers have outside of the regular 30-year fixed mortgage that will help combat rising interest rates and give you the opportunity to get the house you want. Without further ado, here's Hal Sweasey team member, James Bueno.
All right, everybody, welcome to another SLO County Real Estate with Hal Sweasey podcast. As always, we have Hal Sweasey. How are you doing, Hal?
I'm great, James. Thanks.
Mr. John Turner, JT.
Hey, James.
And JP from Keller Williams.
James, great to be here.
Today's a special day, Hal, and can you explain why that is?
We got a lot of questions about the mortgage industry and mortgage market, so we realized our limited capabilities there and brought in some specialists. I'm looking across the table at Ermina Karim, Vice President of Mortgage Lending for Guaranteed Rate, and I have Chad Van Til, who is the owner of Pacific Trust Mortgage.
Can you guys talk to us a little bit about what's happening in San Luis Obispo County?
Well, as we all are probably aware, that rates have gone up quite a bit since 6 months ago when we were at our historic lows. So we're certainly dealing with a little bit of change in the market when it's related to our buyers, because affordability with your increase of rates has decreased a bit. So from our standpoint, we're seeing people switching a little bit over to some of the alternative products where before, I think Ermina could agree that she was probably originating, and our company as well, 90% of what we were doing was fixed rates there, right, because we're at historic lows. So it was hard to not advise somebody to get into a fixed rate to go ahead and secure it for the long run. And now we are seeing some alternative products and more of the ARMs come into play. They're making a little bit more sense. For the past 2 years, you really didn't see too much of a spread between the fixed rates and the ARMs. So the savings were small.
ARMs being
adjustable mortgages,
yeah.
Yes.
Yeah.
So now you're seeing a pretty large gap between your fixed rate and adjustables, where it may make some sense to go ahead and look at some of the adjustable rate mortgages out there.
Roughly, what would be the difference today, and what would that look like?
I mean, you can definitely see a spread of over a point for sure,
okay,
or greater on the 1.5 actually on some of the things that we've been locking recently, and some of these offer 7 and 10 year fixed rate period at that lower rate, so it can make a lot of sense for a buyer to be able to afford the home and bet on where the market's going to go over time. And while it's been a bit of whiplash over the last 6 months, and there have been challenging conversations I'm sure you've also had, when we step back and we look at where we are today, Freddie Mac has put out average rates over the last, since 71, I want to say, and the 50-year rate is 7.8 between 1971 and 2021. The average mortgage rate, 7.8%. And so when you look at where we are, it's a shift in the market. There's no doubt about that, but we continue to be at a place that is low historically.
Yeah.
Just not as low as people were experiencing.
Is that why you guys keep wine in your office to give to your clients?
There it is.
Tell them about today's rates versus what they
Them paying a little bit, perceived pain.
Yeah.
Over the past 50 years, you were looking in the sevens. I remember when I got into the business in the 90s, and we were doing cartwheels when we broke 8%. That was there, and it was exciting times there. And when we saw them in the twos, obviously, it's been unprecedented. Nobody's seen anything like this. So 5% overall is still good money out there. It's just, once again, hard to swallow when we were looking at 2-3% only a handful of months ago.
So you got to deal with the reality. The truth will make you mad before it sets you free. But we're seeing it from my perspective. I think people have now kind of adjusted to it. So it's just like, okay, well, this is what mortgages are. We're going to deal with that. But the fact that you have those options sounds good. Do you guys do any of those three? Well, I'll have you explain it, but like a 3-2-1, is that common? Because that was common I don't know, the early 90s or something like that. We used to see a lot of those where you get a fixed rate, but you buy it down over the term. Are you seeing any of that, or is that
coming back a little bit? We didn't see them in the last couple of years because you couldn't do a 3-2-1 buy down when your rate was 2%. You'd be inverted interest rate. So so unfortunately, we didn't have any inverted interest rates to offer, but we are starting to see them coming back a little bit. We're also looking at some tools like 40-year amortization out there as well, which is a little more affordable for people to get into with that program. There's also interest-only loans out there as well that are interest only for the first 10 years and then fixed out for the last 30 years. So it offers some of that payment flexibility for those first initial 10 years, but also the stability of a fixed rate in case we do shoot up in rates. But as you can attest to more than anybody here, your average homeowner isn't in their home for 10 years for the most part. So looking at some of the adjustables right now, especially when you're getting into the first-time home buyers, the transition buyers, usually they're not going to see it even go to the term for the 7 years that Ermina was speaking about, the 5, 7, or 10 years that are your most typical adjustable rate periods.
But if that's the case, then you would do the John Turner strategy, right?
I'm going to do a 5, a 7, 1 adjustable rate mortgage because I know something's going to happen in my life where I'm not going to keep a 30-year mortgage. I'm going to move, or I'm going to need to maybe take some money out of my equity. Something's going to happen in my life.
And Ermina, so people know, what's a 5 or 7-1 that John was saying?
Absolutely.
How do you describe that to the first time
absolutely.
borrower?
So, it's the period of which the mortgage is fixed. So the 5-year, 7-year, or 10-year fix, you'll see minor differences in rate for those periods. There are some different qualifications based on a 5-year versus a 7 or a 10. But essentially, it means that you are locked in at a lower introductory rate for that period of time for your 30-year loan. And then it ties to movement with a market index.
Okay. So I'm a first-time home buyer, and I've been looking for a year, and you know how hard it's been to find a house. Now I've found the house, and interest rates have gone up a couple of points, right, or more. What's the conversation look like when I'm sitting talking to you about how I proceed and how am I going to be able to afford this house because the rates are up? What's that conversation look like with you guys, and how do you coach me and advise me?
Well, you sit them down first with a glass of wine if they haven't been informed or in contact with you to brace from where the rates were. And it's really, starting with what they could afford. That's where we always, because there's a difference between what you could qualify for and what you could afford based on what your comfort level and budget is. And we go ahead and try to really work around what that comfort in their household budget is. And then really also try to talk about what their plan is for this house. Sometimes when you're doing a pre-qualification, it's hard to know what their exact plan is for the house if they haven't picked out the house. But usually if it's a first-time home buyer, they're getting into something that, once again, maybe for that 3 to 5 to 7 year period, because it's going to be a starter home. Maybe they're going to plan on having kids, so they may need an extra bedroom, and really try to go ahead and fit this home and their purchase into what their financial plan is, and really focus on really what it is they could afford, and then work into the product from there, whether it's the 3, the 5, or the 7 year fixed, or a 10 year fixed, or maybe it does need to be a 30 year fixed, because that's what's going to make them sleep best at night. Because some people just are very risk adverse, and they don't want to know that somewhere down the road that interest rate may change.
Chad, you had mentioned the 3-2-1 product. For the listeners that might not know what that is, what is that? What is a 3-2-1?
So basically, you're buying the interest rate down up front. So if your rate were to start at 5.5 is what the fully indexed rate is at the end, you would start off at a 3.5, and then the next year would go to a 4.5, and then it would go to a 5.5 rate. So you get some relief in those first couple of years.
I want to jump onto some of what Chad was saying as well. I mean, I think that when you're talking particularly to a first-time home buyer who's been, watching the market change in front of them, and hopefully, as Chad was referencing, you've already been having conversations along the way. They're tracking what's happening through their search process because you're partnered with them. We're partnered, lenders are partnered with agents to help serve the client. I think so much of it is also around addressing these myths we hold about buying a home in this country. I think there are myths around, well, you have to have 20% down. Well, no, you don't. Or myths like, mortgage insurance is bad. Well, no, it's not necessarily bad. If it's going to help you, if you can, it can be a much more affordable option to get into a home and put less down, and rates can be actually quite attractive. Or you can buy out your mortgage insurance in front. And so there's so many tools. It's really the strategy that's going to fit somebody else's life and helping them to understand what the tools are available to them and confronting the storylines we may carry. There's a lot of shame in money also. And so helping people to understand you're not supposed to know this. This is not your business. It's our business, and we're here to help you with that.
Think about if you waited from 2018 to now to come up with that extra 10% down, because they didn't want to carry that extra little bit of debt, what that costs, and not only the appreciation that they lost, but now also the cost of funds there as well.
For those that were in the market that back in 2004, 5, and 6, can you talk a little bit about the difference and why those that might have been in the market now, they're saying, "Oh my gosh, these options are coming. Is this the turn? Is this happening again? Is 2008 going to happen?" These lending practices, are way different than what happened back then.
I would say now we're probably of the strongest credit quality that we've certainly been in as long as I've been in the business. Underwriting has been so stringent since the meltdown in 2008, whereas prior to those days, yes, there were some of the unique products that were going out. But you got to remember the underwriting standards were almost non-existent. That was there. You weren't verifying income. You weren't verifying down payments. People were looking at basically credit scores there. There was highly leveraged financing for these products at 95, even up to 100%. There was the deferred interest loans that were there so that people were allowed to go over what 100% of their value was. So the risk profile from underwriting was so different than where we are today. As I said, right now, the strength and the credit and quality of the mortgage-backed securities that are out there are, I think, as strong as they've ever been.
That's great to hear.
That's a huge factor in terms of people worrying about there being some sort of panic or the market shifting drastically in terms of pricing, and it just doesn't seem to be in the cards.
I don't see it happening because of the quality of mortgages that are there. Also, and people not being able to afford it because a lot of these people before were banking on appreciation. They figure, well, I could hold it on a deferred interest loan that starts at 1%, and I'm going to hit my 10% appreciation per year, and then I'm going to sell and I'm going to walk away with $100,000 in appreciation. Yeah. And then when the market started tanking and they couldn't afford the mortgage, they had no choice but to give the keys back. Yeah. Now, everybody needs to go ahead and down payment. You need to fully underwrite income. It's a completely different, as I said, quality of borrower that has been able to get into home ownership and loans over these last few years.
Yeah, makes sense.
Are there programs, let's say I have a 650 or lower credit score, but I have a down payment. What other programs are out there for somebody with maybe not as great credit or not enough down payment? What's available?
Well, FHA is probably the one that's most commonly referenced for. You can go down to 3.5% down, and you can. It's more lenient on credit quality, and so you pay a higher price in your mortgage insurance, but ultimately it's a way that buyers can absolutely get into a home, and it's backed by the government. It's a strong program for the right borrower.
And I'll go a little bit backwards on what I was just saying, because there are some alternative programs that have recently come back that are called non-qualified mortgages out there, right, that are allowing a little bit more flexibility for borrowers here as well. The difference, I think, between with the non-qualified mortgages, their guidelines now versus in 2005, 6, 7, are that they're you still are having to underwrite income, but it is a little bit different than what Fannie Mae will require. You could do it through a different kind of bank statement showing cash flow, through 1099 income, through asset depletion programs, some things that are for well-qualified buyers that are still coming in with that 25, maybe 30% down, but they might be self-employed and have a little bit more of non-traditional income. So there are some avenues that are out there for somebody that isn't going to qualify for either an FHA or for a Fannie Mae or more traditional loan.
And the programs that Chad is referencing are, I would say, have a special appeal in this market. Our region is made up of small business owners, and there's a lot of self-employment in our community. What they're doing for taxes or whatever their situation may be can be more complicated to get through the loan process. So these products are a good fit for a number of borrowers in our community.
So, Ermina, a few minutes ago, you made a positive comment about PMI.
Yep.
You're probably the first person in the world I've ever heard make a positive comment. Can you? Maybe I just don't understand it well enough. Can you kind of explain what PMI is, and then maybe why you made a positive comment?
Sure. Well, let me say that my what you interpreted as positive was don't be afraid of it, and I guess so. PMI, private mortgage insurance, is, for the lender if you're putting down less than 20%. And so it definitely has, because we have this myth that we need to save for 20% down, the balance. So something less than 20%, you have to get mortgage insurance. There are numerous scenarios, and it's tied to your quality so the price of your mortgage insurance will be improved, meaning lesser, based on the quality of your credit and the percent down you're going to put into the transaction. So depending on a client's goals, if you are focused on, for example, maximizing cash conservation, for example, it can often make sense to put 15% down, for example, say that 5% that you're not putting into a transaction, which at our home prices is a significant dollar amount. And if your credit's decent, you can buy out your mortgage insurance up front at closing for, say a $500,000 loan and your credit score's 750, you're looking at probably just a couple $1,000s to buy out that mortgage insurance up front. So you're never paying it. As long as you can carry that loan, you've conserved your cash, you can put that money to use maybe in a different way and not take a hit on rate. In fact, the rate can be quite attractive at 15% down. So I think, in addition to what Chad previously referenced, sitting out in the market waiting versus paying the monthly mortgage insurance, you're losing out on the appreciation and the value of that dollar to really put your money to the best use possible. So I would say don't be afraid and talk to your lender.
Great. Thank you.
And Ermina pointed out here, which is spot on, that sometimes it's strategic to do that, to keep that cash. And a lot of times that we're seeing it in the purchases is for improvements to the house. Because a lot of times you're buying something that you said, I'm stretched at 20%, but sometimes it makes a lot of sense to put that 15, pay that little tad bit of mortgage insurance, keep that cash to get the house livable. And maybe that helps you stretch into that purchase price that you...
If I'm pre-qualified, can I go buy a house?
Everybody has a different definition of what a pre-qualification is. For us, pre-qualification is certainly more limited than what a pre-approval is. A pre-qualification is a basic review of your income and your assets and your debt-to-income ratios and your credit that's there. When we're doing a pre-approval, we're doing a deep dive, really factoring what your debt-to-income ratios are based on all of your documentation of your tax returns, your pay stubs, your W-2s, pulling the credit report, reviewing the assets, taking it through an initial underwrite, either through one of the automated systems or even getting it pre-approved by the underwriter itself, so that you know that you have a very solid approval going in with your offer. So really then it comes just contingent on the property, which is usually the appraisal and the preliminary title report.
And doing that last bit is, really actually getting an advance approval essentially prior to an identified property is, you were referencing as we were getting started about what you're seeing in terms of cash buyers. And of course, for Chad and I working with loan clients, it's difficult to compete with somebody who's coming in with a loan versus somebody who's got cash. The fully, a credit approved file means that a client can go in if they choose and waive their loan contingency. So they're nearly as competitive as cash because they're telling the seller, I've got a loan, minus the fact that I need a purchase contract and an appraisal likely.
I think, as far as I know, we're the only country that I'm aware of where you can get a rate locked for 30 years. Right? Most of it, like Canada and Australia, whatever,
correct.
5, 10 years. 30 years is like unheard of. right? And then they'll
Yes.
lock it in below the historic average of 7% at 5 or 5.5. I mean, sometimes it's good to get that perspective, it seems like, for our
right.
clients. Yeah.
So I'm the guy that Hal was talking about. I buying my house today. I lock in a 5.5% rate. The rates go to 7, and I'm thinking I'm pretty smart, right? I'm feeling really good about myself. Now, the other person that Hal was talking about is 2 years from now, the rate goes to 4. What do I need to do between now and then so that when I walk into your office and go, hey, I hear rates are at 4, I'm at 5.5, let's get the refinance process started right now. Let's get it done fast. How do I prepare for that? What would you tell me that I need to do between now and then?
We're trying to give good credit counseling. So that's a very easy piece that has probably the most impact for the average participant in the market to understand what's happening with your credit and your debts that you could be making shifts to ensure you're getting the best lower long-term rate.
So can you define good credit counseling for the person on the street?
Sure. And so essentially, many third-party vendors, so the third-party vendor that we work with, and I'm sure Chad does as well, they're able to do it. They work with the credit agencies, and they're able to do an assessment about your payment patterns and how much debt you're carrying relative to the amount you're able to be issued. And so they'll look and assess and say, well, if you were paying this one down a little bit further or more consistently paying, or looks like your score is at what we were seeing before, 650, if you make this shift in your education loan, whatever it might be, it's going to make a boost to your credit score of 40 points or 20 points, and it will project out the impact of making changes to your payment patterns. And so that boost in credit will typically have a really strong impact for a borrower down the road.
So one of the things we talk about with first-time buyers or people getting started is, the process. And it's like, okay, are we just in the exploratory phase? Are we fact-finding, or like, are we ready to buy? And, we say there's 3 steps to it. One is kind of identify where you want to buy a house. 2, get with a good lender, assuming they're going to get a loan, unless it's one of those crazy people that pays cash. And then 3, find a real estate agent. And as we listen to you guys speak, and we do this all the time, there's so much more that you know than we know. And it's just amazing, because people assume I know a fair amount, but I know some, but you guys are doing it every day. So just having that specialist, it's probably why you have somebody that is one degree of medicine in orthopedics for fixing your leg, and somebody else is going to work with your spleen, right? And it's just really amazing. Now, we kind of turn this around because we're real estate agents, but we usually say, I put them in that order: find the neighborhood, get a good lender, get a realtor. Well, if you get a realtor first, they probably know who the good lenders are. And, they can help a client with that, like you guys.
Definitely.
And then they can also say, well, if this is what you're looking for, you might want to consider this area or that area. So in all, it just takes a teamwork to do, but I'm just amazed, having done this for a long time, how much more I can learn by spending more time with you guys. So I want to say thanks for being here and sharing that with us.
Thank you.
Appreciate it.
Did you guys have fun?
Great.
Definitely.
Great time.
Yeah, thank
pleasure
you.
to be here.
Want to let everybody know how they can get a hold of you in case they're looking for some lending help.
Sure. You can reach me, Chad Van Til, at Pacific Trust Mortgage at 805-543-4422, or our website is pacifictrustmortgage.com.
And you can reach me, Ermina Karim, at Guaranteed Rate. My phone number is 805-602-0248. And you can email me at any time, or my partner, Donna Lewis, which is Donna.Ermina, Ermina, at rate.com.
Okay, thank you guys, and we'll see you next week.
Thank you.
Thanks, James.
Thank you for listening to the Hal Sweasey podcast. Be sure to subscribe and rate this podcast. It comes out every Monday, so check for it in your feed for the latest information on the San Luis Obispo County market. The SLO County Real Estate with Hal Sweasey podcast is available wherever you get your podcast, and on halsweasey.com, where you can find current listings and other real estate tips. halsweasey.com, that's HALSWEASEY.com. I am James Bueno, Director of Marketing for the Hal Sweasey Group. If you're looking for anything real estate, give us a call, 805-781-3750.
Hal Sweasey is a licensed California real estate broker. DRE number 01111-911. The SLO County Real Estate with Hal Sweasey podcast is a production of AGM Podcasts. Subscribe wherever you get your podcasts.